Morning, everybody, and welcome to Tait Walker's 2021 budget seminar, probably going to be known as the Tees Valley budget in future years. I'm sorry we can't all be together like last year. Enjoyed a bacon sandwich and a chat, but hopefully that will change in the near future. In terms of the agenda, which is on the next slide, I'm going to do a very brief introduction, try and set the scene upon which this budget was delivered. We'll then look at the major areas of tax from a personal, wealth, corporate tax, employment and VAT perspective. And then at the end, Alistair will bring it back together, look at those things that were in yesterday's speech that perhaps we haven't covered, but also try and bring it back together. In terms of questions, we intend to have an area at the end. We're hoping to speak for just over an hour, so therefore there'll be time at the end to look at questions. There is a chat function, which is the kind of icon. So if you want to raise any questions, please do so. If they can be answered very quickly, I think people are going to do that kind of online. But if there are any questions of broader kind of interest, then they'll be picked up and dealt with at the very end. The next slide, it just merely introduces me, so I shall pass over that very quickly and talk about the situation in which we find ourselves. It's very easy to forget how much things have changed. This time last year we had a budget and the word furlough wasn't mentioned once. We had a get together where we didn't have to social distance, we didn't have to wear masks. Austerity was finally coming to an end. The government had major plans to invest and try and grow. And following their election success and the fact that had been driven slightly by the North for the first time, they were going to really put some effort into closing the North-South divide. And our key concern really at that time was probably Brexit. So how things have changed. On the next slide, I've just put a very simple graph, hopefully, which I'll see in a second. There we go. And that just shows the impact that COVID has had. The little red blotches in 2008, 2009 were the financial crisis-led recession, which was a deep and severe recession. But you can see that at the peak, it only really caused a decline of 2%. At the beginning of last year, we saw a decline of 20%, which is unprecedented across history and is a massive impact on our economy. Next slide, please. These statistics really then look at what impact that had on the UK economy. Unemployment has risen from a very low 3.1 back up to 5.1. At the peak, we had 9 million people furloughed. That still covers 4.7 million, largely obviously from retail and hospitality, but it's still a significant number of people. And we don't quite know what's going to happen as furlough comes to an end. But despite that fact, we've carried on. The government's borrowing is now predicted to have increased by 400 million. And tax revenues have declined. Tax revenues have declined by 9.7% to 38 million for. So if you then look at that, you start to say, well, our annual tax revenues are roughly 400 million, and we've spent that and another 400 million on top, 400 billion, sorry, on top, thanks to COVID. So you can see the scale of the spending that's had to take place to try and keep the economy going and look after people in what have been unprecedented times. Productivity has always been an issue, particularly for our region, and that took a massive hit with what happened last year. Whilst it has recovered by the year end, it was still 1.1% down. And obviously there'd been an impact for people generally. 46.6% of people were working from home in April 2020, which was a massive jump due to the lockdown. Next slide, please. This slide then looks at the impact for the North East. We try and set the budget in the context of what the North East requires. I haven't this year done many statistics, and that's largely because what happened to us mirrored the rest of the UK. Frequently we're an outlier, and therefore we need something specific, something that's different to the rest of the country. This year what happened to us was very much in line with what happened elsewhere. So our unemployment rose from 4.4 to 6.5. That headline figure hides the real issues to do with youth unemployment. Youth unemployment is now twice that of other age groups. There was disruption to education and training, something that's vital for a region like ours that's hoping to generate wealth. Capital investment was delayed. Business confidence fell to an all-time low. The gross value added, which is a measure of what we produce, fell by 8.3%. It fell more than that in the first half of the year and then recovered in the second. But that's a very, very significant decline. In pulling together the figures, a couple of things I would mention. Firstly, I think for the first time ever, it's very difficult to get full Northeast figures. There is a definite split between Tees Valley and the rest of what I would classify as the Northeast. But also, I think the figures that you can find show a remarkable resilience. That the headlines are clearly down because it had such a massive impact. But actually, there are lots of green shoots there. Business confidence has rebounded. Opportunities, numbers of jobs that are available have started to increase, job offers. The number of new businesses created outweighed those that have gone down, albeit of a different size, but it shows an element of entrepreneurship in hard times. So I think there are some real positives and we shouldn't forget those. Next slide, please. I put this in because I thought it was interesting, and it's a study for the whole of the Northern Power region. So it's not just us, it's from Manchester and Leeds and everything else. But I think it's the thing that sometimes you can forget, particularly us who work with numbers. You tend to look at numbers rather than realities. And what this was a study on is the impact of COVID on humans, particularly in the north. We had a higher death rate than the average. We've had significant issues with mental well-being. Child poverty, which has always been an issue for the region, has got worse. And all of those things, you can't forget the human side of it, but actually all of those things have a negative impact upon our sector, upon our region. The mental well-being they estimate for the northern region will cost 5 billion in lost productivity, and it just shows that it's not just about trying to attract investment and people to spend on retaining people. It's looking after the mental health, etc., of the people we have around us. So I just wanted to mention that very briefly, albeit it's a huge topic on its own. So in the next slide, what were we hoping to see? And this was genuinely written before yesterday's speech, but we were looking for continued COVID support. The economy clearly has issues still, and therefore we thought it was too soon to withdraw that support. We were looking for stability and a long-term plan, rather than kind of knee-jerk reactions to where we were. We were looking for incentives to encourage investments, particularly to encourage business to take this opportunity to adopt new technologies and move to the new green industries. We didn't want to see significant tax rises. We felt that would have a negative impact upon an economy that was already having difficulties. If we were going to see tax rises, we wanted to see those kind of push towards those people who've done well during COVID and to those areas where inevitably we need to change. So a plastic tax to reduce our consumption of plastic, etc. Next slide, please. We also wanted to see incentives to encourage people to employ, but also to improve the quality of that human capital. So encouraging further training, apprenticeship schemes, ideally, because that helps the younger generation who we said have suffered more from unemployment. We wanted to see those promises of the north-south divide being closed, being actioned. And we wanted to see that the capital investment projects that they'd headlined last year actually go ahead, particularly those that are relevant for broadband, etc. The last 2 points we put on there because they're slightly different, but there's inevitably now, with the amount of borrowing we've got, the amount of cash that's available in the market, that pent-up demand, we're starting to see inflationary pressures, and that could have a major impact on interest rates. And that was something we wanted the government to acknowledge and be careful of. And also, following Brexit, whilst we have a deal, we've seen lots of problems, particularly for exporters getting their goods abroad, and certain quotas restricting imports, etc. So we wanted the government to acknowledge that and potentially look to do things about it. So what did we actually get? Before I hand over to the guys to start looking at the particular taxes, I'll revert back to Tees Valley. We've had a Tees Valley offering for many, many years, but we last year bought a new building and refurbished it. We managed to do that during lockdown, a considerable investment, and the picture is us with Ben Houchen when that office opened. So I think the government obviously saw that investing in Teesside was clearly a good thing to do, and they followed us. Some of the announcements yesterday were the new Treasury campus that's going to Darlington, that will bring 750 great jobs up from London initially, but they hope that will attract other things. There were 8 free ports announced, one of which went to Tees Valley, who were very much at the leading edge of driving the free port drive. It's worth noting that it isn't just at the port on the Tees, it actually covers areas across that region. So Hartlepool has an area, Teesside Airport has an area, Wilton has an area. So it's a big impact for the whole of that area. There was some money to be put into from both state and private money that's going to be split between the Tees and the Humber to encourage green energies, particularly offshore wind. There were town deals announced for Middlesbrough and Thornaby. Middlesbrough, I think, is 22 million, Thornaby is more. Darlington are getting an additional 5 million to help with vaccine research. Hartlepool are getting money for a cultural centre. And actually the one that I missed off there, because I didn't see it until after I'd written this slide, is there's also 4.2 billion to be shared amongst a number of cities to help their intercity transport, and Tees Valley are part of that. I think what was noticeable is that nearly everything that would help what I would classify the region was all centred on Tees Valley. I think the rest of the region will look in envy at what they've got and wonder why it all went there and didn't seem to go anywhere else. I suspect there's a political thing to that and something that perhaps the rest of the region needs to learn from. But that's kind of beyond our remit. So at that point, I shall hand over to Chris, who's going to look at the private client aspects of yesterday's budget.
Hello, everybody. My name is Chris Hodgson. As Andrew says, I'm looking at the private client side. That's things like income tax, capital gains tax, inheritance tax, that sort of stuff. Next slide, please. So we'll start with income tax allowances and rates. So your personal allowance, which is the amount you can earn before you start to pay income tax, increased by £70 for the coming year to £12,570, and the basic rate band goes up by £200 for the coming year to £37,700. Next slide, please. So applying that to real people, if you're earning £15,000 a year, how does that affect you? Well, your tax bill goes down from £500 to £486, so you're saving £14 over the year. So don't spend it all at once, but it's there. If you're on £60,000 a year, so that's the next slide, okay, the income liability goes from 11,500 to 11,432, so you're saving £68 because you've got the benefit of the personal allowance increase and the increased base rate band combined within those figures. Now, next slide, please. The big issue that came out from yesterday from the private client side of things into the headlines was that the personal allowance and the basic rate band haven't been increased in 21-22 will be frozen for the next 4 tax years. So up to and including the tax year 25-26, they'll stay at £12,570 and £37,700. So if they had kept on increasing the figures in line with inflation, that means that by the time you get to 4 years hence in 25-26, the extra tax payable by a person on £15,000 a year is £56 a year. The person on £60,000 a year will be paying an extra £272 per year. So as a percentage of what people earn, it's not a big figure, but if you multiply that up by the number of people who pay income tax, the actual revenue raised is somewhere between £8 and £9 billion just from doing that. So that's why they're doing it, to help start to pay down that debt that we've all built up during the pandemic. Next slide, please. National insurance is the other side of taxation, as it were, for employees. The rate at which you start to pay the NIC goes up by £68 to £9,568, and the point at which your payment goes from 12% down to 2% goes from £50,000 to £50,270. Next slide, please. Dividends. There had been some talk beforehand if you took a dividend from a company the rate of tax on those dividends could be increasing. Well, that hasn't happened yet. The rates are still the same now, although there are some consultation documents coming out on the 23rd of March, and it's thought that some of the bad news about tax increases may come out at that point in time. We'll see. Next slide, please. Income tax, if you're a sole trader or a partnership and you make a loss, at the moment you can carry that loss back from the tax year in which it arises to the previous tax year and get relief for that loss. But if you make a loss in the years 2021 or 21-22, you can now carry that loss back for up to 3 years using the loss in the later years first. So if you've made, say you've got a pub and you make a loss in 2021 because of lockdown and the effects thereof, that loss can be carried back to 1920 tax year, as is always the case, but it can also be carried back to the 18-19 year and even 17-18 as well, if the loss is large enough. So that triggers the ability to get some repayments back, which will help you to have the time to get back on your feet in terms of the trading of your business. Next slide, please. The Self-Employed Income Support Scheme has been a major plank of how a lot of self-employed people have kept going during the times we've had over the last year. There's been 3 grants paid out so far, and the details of the 4th grant were announced yesterday in the budget. The maximum payment is still capped at £7,500, but it will now take account of profits for 2019-20. So some of the, as they've been termed, forgotten, who haven't received any sort of government support, sometimes because of the fact that they've only gone into self-employment relatively recently and therefore weren't self-employed as at 5th of April 2019, they will now receive help, which is obviously great news for them. And I think it's probably about time that that was done. Applications for the 4th grant can be made from late April up until the 31st of May 2021. So it's important to do that and to get those applications in to Hmrc. A 5th grant is going to be available as well. That's coming out at the end of the summer. The calculation of that is going to be different because it's based on reduction in turnover in the year ended 5th April 2021 as compared to the previous year. If the turnover reduction is at least 30%, the grant's 80% of 3 months of trading profit with a cap of £7,500, which is exactly the same as the amount you will get paid under the other iterations of CEAS. If your reduction is less than 30% in your turnover, then you do still get some money, but in that case, the grant's only 30% of 3 months of trading profit. So the cap in that case is only £2,850, but it's still worth having. Further details of that 5th grant are going to be issued in due course by HM Revenue and Customs. Next slide, please. Making tax digital for income tax is a system that's coming in for self-employed individuals, partnerships and landlords with rental income of more than £10,000 a year. And it requires them to make quarterly reporting to Hmrc of income and expenses. And that applies from April 2023, so roughly 2 years from now. This was to have come in from April 2019, but it was put on hold by the government. But it appears it's definitely going to happen this time. It's part of their efforts to try and close the tax gap and raise more revenue from us all. And why we think it's definitely going to happen is because the budget includes a note on the merger of rules for the late payment of VAT and the late payment income tax under Making Tax Digital. So if they weren't intending to introduce the new rules, you wouldn't have to merge the rules for the late payment of those taxes. Next slide, please. On capital gains tax, the exemption for 2021 increased to £12,300 from £12,000 for 2019-20, but for the coming years, up to and including 25-26, it's staying at £12,300. So it's not, again, that's being frozen. There were no change in the rate of CGT, which is actually no news. It's definitely good news because there have been a consultation document suggesting that the rate of capital gains tax could be aligned with the rates of income tax. So we could have had capital gains tax up to 45%. That's not now happening yet. But again, there's more information probably coming out in due course, but for now we can breathe again. There's also the relief on a sale of a business where you can get a 10% tax rate on gains up to £1 million. The business asset disposal relief has also been retained as well. Next slide, please. So finally, on the inheritance tax, the main residence nil rate band, which is the nil rate band relating to passing your house down to your children, has now increased up to the maximum of £175,000, which means a married couple or civil partners can have £1 million free of inheritance tax now, which is obviously great news. But again, those figures are also being frozen until 2025-26. So those figures are what we have now for the next 5 years, as it were. So that will bring some people over that time back into inheritance tax as asset values rise. But that's where we are at the moment. So I'll now pass you on to my colleague, Mark Parkinson, from our Wealth Management Department to look at those sections of the budget. Thank you for listening. Bye-bye.
Thanks, Chris. If you could go to the next slide, please. So from a financial planning and a wealth management point of view, as ever, the lead up to the budget, it was topical to talk about pensions and the fact that the government spends in the region of £40 billion a year on pension tax relief. We did expect to see some changes. However, certainly from an annual allowance and what you can pay into a pension, there wasn't any changes. The change that was announced was the lifetime allowance being frozen until April 2026. So the lifetime allowance is how much you can save into a pension before tax going over a certain amount. So you can see there on this slide, going back to 2011-12, the amount you could hold into a pension, which wasn't subject to tax charge, was 1.8 million. In over recent years, that's gradually reduced. And then in 16-17, it did increase in line with inflation. But the government announced yesterday that the lifetime allowance is going to be frozen at the current level of 1,073,100. Now, I was reading last night just to see what the press thought about it, and one of the comments I read was the British Medical Association has warned that senior doctors will retire early to provide tax charges of up to 55% for breaching the lifetime allowance. So that was really interesting. We also have spoken to a number of clients over recent years that have maybe transferred out of their final salary pension scheme, and certainly those people with high pension values could be impacted by this change. So it is something that we are talking to clients about. So next slide, please. So as I've mentioned, the lifetime allowance was due to increase in line with CPI. That's been frozen until April 2026 at 1,073,100. Next slide, please. The other announcements, nothing really surprising from an investment point of view. The adult ISA annual subscription remains unchanged at £20,000. The junior ISA and the child trust fund, again, the subscription limit remains unchanged, current levels of £9,000. The government did announce that they will be offering a green retail savings product through National Savings and Investments, which is due out in the summer of this year. The product will be closely linked to the UK's sovereign green bond framework, and it will give all UK savers the opportunity to take part in the collective effort to tackle climate change. And we are talking to clients more and more about more ethical and more green investments. So that's something that was welcome in yesterday's budget. Next slide, please. As I mentioned in the first slide, there was talk that the annual allowance, how much you can save into a pension, was going to change. The good news is that didn't change. The current limit is £40,000. However, for those earning over £240,000, that does reduce by £1 for every £2 of adjusted income. For those earning over £312,000, the maximum that they can pay into a pension remains the same at £4,000. However, there is another test for income, which can help those who may be caught out by pension savings if the pension savings exceed £40,000. So even if their adjusted income is over £240,000, the annual allowance is not cut if their threshold income is £200,000 or less. And we have many clients that we help on that subject, working closely with our tax department. I'm now going to hand over to my colleague Andrew Fitton, who's going to talk about corporation tax.
Thanks very much, Mark. So quite a number of changes on the corporation tax front, and I'll take you through those. Oh, next slide. Thank you very much. So the first one, a significant increase in the rate of corporation tax from 1st of April 2023, from 19% to 25%. Businesses with profits of less than £50,000 will be continued taxed at 19%. So we'll have the differential between what used to be known as the small companies rate and the normal rate of corporation tax from 2023. And there will be a taper to take companies from £50,000 profit to £250,000 profit between the 19% rate and the 25% rate. So a significant hike. The point at the bottom, just on diverted profits tax, there was quite a little bit of commentary and sort of chat about what would be done around online retailers and digital businesses who perhaps benefited during the pandemic, and what could be done about the tax planning that they may employ. There has been legislation in place since 2016 that is designed to sort of challenge, certain tax planning that online companies used to engage in. It's called diverted profits tax. It's also known as the Google tax, and all the change really there to take to take that tax into penal tax if they engage if those companies engage in certain types of planning, and all that does is really sort of keep the differential between the diverted profits tax and the corporation tax rates from 25 to 31%. It won't affect a lot of Northeast businesses, but that's just that change. Next slide, please. So just looking at a graph, and we were commenting upon this last night as we looked at the budget in detail, that we can see that since 2010, there's been a steady decline in the rate of corporation tax down to a low of 19%. And you may recall that prior to the election of the current Conservative government, it was actually planned that the rate was going to go down lower to 17%. And one of the main reasons for that was international competitiveness. That the UK would be the most competitive economy in the G7 and perhaps the G20 in terms of attracting international investment. Obviously, perhaps the biggest hike I can remember in my career of 30 years in terms of the increase in corporation tax, that big step in 2023 up now to 25%. The argument for being able to do that is we will still have the lowest tax rate in the G7. President Biden in the US has talked about pushing tax rates up towards 28%. Other countries will have higher rates as well. So the argument follows that that as the UK can sustain a higher rate of corporation tax and still remain competitive in attracting international investment. That's the argument that's put forward. Whether that's right or not, I don't know. But 25%. Next slide, please. Just in terms of associated companies, so when looking at the limits of £50,000 and £250,000, you don't just look at one company in isolation. If that company has associates, then they've got to be brought into that pot as well. And so the limits, the thresholds will be reduced where there's associated companies or where there's short accounting periods, so accounting periods of less than 12 months. The definition of associates is changing slightly, both for this and for in determining when a company falls within the quarterly payments or the very large corporate payments regimes. So those limits could come down to very, very low levels, and a lot of companies could find themselves in the 25% rate if they're profitable. Next slide, please. Just a point on deferred tax, and deferred tax really is a sort of a topic for people who get involved in preparing statutory accounts or group reporting for groups of companies. It's not actual tax you pay, it's an accounting concept that deals with the difference between what your accounts show and what your tax computations show, and whether there might be adjustments for that in the future in terms of relief that you would take for tax in the future, or further income that might be taxed in the future that's accounted for now. So only an accounting concept, The point around it is that when you're trying to account for that deferred tax, and you're trying to reflect a possible deduction in the future or a possible additional income in the future, what rate do you apply? Do you apply 19% or 25%? And I think the point around this is deferred tax calculations for companies who prepare those will become much more complicated going forward, with much more sort of interaction, decision making, and determining, you know, when things will crystallise. Next slide, please. The next big announcement, so after the corporation tax rates, the next big announcement was the belief to be able to carry back losses, not just for 1 year, but for 3 years. So the 1 year carry back, you know, continues as before, but now companies can carry back trading losses for up to 3 years, limited to £2 million per year for the for up to 31st of March 2022. So a substantial additional relief there, because now, you know, companies that have been impacted in the pandemic, they can access 3 years worth of profits prior to the pandemic rather than just one. Previously, you could go back 3 years, but that was only on termination of a trade. So substantial. That cap applies per group. So if in groups of companies, then you're looking at a group as a whole. But if you've got short accounting periods previously that you're carrying back into, you don't pro-rata that 2 million down because you've only got a 6-month accounting period. You just look back over the course of the full 2 years. Okay. Next slide, please. So looking at a quick example, we'll just sort of quickly touch on this. So, you know, a lot of companies might find themselves in this position where they've got losses in 2022, losses in 2021 because of COVID-19, coming out of COVID-19, but they had profits in the previous 3 years. As it stood, they'd be able to carry back losses for 1 year from 2021 backwards to 2020 and get relief of 1.1 million. Because of this change now, they can also carry back, in this example, you know, more into 31st March 2019, and they can carry back from 2022 into 2019. Going back from 2022 to 2018, that's out of scope because that's beyond 3 years from 2022. But you can see there that prior to this change, a company might be able to recover by carryback of losses £209,000, but now can recover an extra £574,000. So the total of tax reclaimed there is £783,750 on this example. So, you know, quite a benefit if people want to go back and recover tax. But we'll come on to some of the impacts of that shortly. Next slide, please. I think the point around this is this isn't straightforward, and the decisions that this prompts aren't straightforward. I mean, the carryback is only for trading losses. That's one key point to make, so investment companies can't benefit. And the carryback does allow a quick cash flow injection. So if you've paid tax in the past and you need to get your hands on cash quickly, then this is potentially an opportunity to do that. But then you've also got to look forward, because we've talked about a tax rate of 25% in the future. And the question would be, well, would it be better to preserve those losses to utilise against profits that would otherwise be subject to 25% rate of tax? But do you know those profits are actually going to arise, or do you just think they're going to arise? So some difficult decisions there. And I think the point around this is planning is key. There's £2 million per group available. Which group member will benefit most? Which group member can predict their profits better versus, you know, gain benefit from carrying back losses, you know, in the case of group situations. So quite a complicated decision process when interacting that with a 25% rate as well. Next slide, please. The loss carryback claims will need to be made in corporation tax returns, and Hmrc won't be able to process returns until this becomes enacted in the Finance Act. So when Finance Bill receives royal assent, effectively when it's enacted as an Act of Parliament, which is likely to be later this year. Those will need to be made on the face of a corporation tax return, but there is a limit of £200,000 maybe made without having to wait at least to submit a return. And so that might be able to be that will be able to be reclaimed more quickly using draft accounts and management accounts. So for companies that really need to access that relief quickly, there is the potential to access something sooner. Next slide, please. Moving on to R&D reliefs. The only real sort of current change now is from the 1st of April 2021, there'll be a cap on the R&D scheme. That's the scheme for SMEs. So repayments are limited to £20,000 plus 3 times the PAYE and NIC liabilities of the company. There were no further actual changes announced yesterday, so there's nothing concrete further announced yesterday. There will need to be, though, sort of reflection of the fact that in respect of the various loans and CGRS support, state aid rules impact on the R&D there. There is also a consequential impacts insofar as, because the corporation tax rate is increasing, that will actually decrease the level of RDEC benefit, because RDEC is a pre-tax benefit. So the rate of corporation tax increasing will actually decrease the post-tax benefit from RDEC. But because of the way the R&D scheme for SMEs is calculated, it increases the benefit for profitable companies from 24.7 to 32.5 if the 25% rate applies. So that can be extremely beneficial. Perhaps the most significant announcement is the government is going to consult over the coming months extensively, and I think that consultation starts in about 3 weeks' time, on the whole scheme and scope of the R&D regime and the R&D incentives regime. Now, that's not to say it's going to be withdrawn, because that certainly won't be the case. But in terms of the definitions, what's included, what's not included, how it's administered, how benefits are paid, that is going to come in for a lot of close scrutiny and consultation, and changes are expected out of that. So that is something to watch out for. Next slide, please. Another big change in corporation tax, lots of big changes. Capital allowances and the super deduction. So there's an increase in relief available for plant and machinery incurred from between the 1st of April 2021 and 31st of March 2023. And what that means is that expenditure incurred between those dates on plant and machinery won't just be eligible for 100% annual investment allowance. What it'll actually be eligible for is a 130% super deduction. So if you incur, expenditure, we'll come on to an example, that gets a 130% deduction in the period you incur it if it's incurred between those 2 dates. Subject to some detailed calculations, again, I'll come on to. It applies to unused plant, not second-hand. Same exclusions apply to an adjustments with respect to things like cars, and you can't create additional plant and machinery spending by just doing intra-group transactions. It's got to be genuine third-party expenditure. And for those people who have contracted to buy plant and machinery already, unfortunately, it doesn't qualify. So contracts entered into pre-3rd of March 2021. That expenditure won't qualify because it's pre the announcement. Just a point on special rate assets. So special rate assets are those that qualify for the lower rate of capital allowances of 8%, not 18%. They don't qualify for the super deduction, but they will be allowed a 50% first year allowance. Although having said that, why would you go for 50% first year allowance if you can utilise your annual investment allowance instead of 100% deduction in respect to those special rate assets? Next slide, please. So just taking a very simple example, with £1 million spend incurred on the 1st of March 2023, the super deduction, if the year end is 31 March 2023, the deduction is £1.3 million. So you spend £1 million, you actually get a deduction of £1.3 million. In actual fact, if you have an accounting period later, though, the actual relief and the actual benefit tapers out, as you pass through at 31 March 2023. So even though you may have incurred the expenditure before the end of March 23, if your accounting period is later, then your deduction may be less. I think what I'd take away from this is, in actual fact, the calculations regarding the super deduction can be extremely complicated. Next slide, please. So just another example of the super deduction there. So we can see the tax saving in year one on £10 million of plant and machinery spend and £3 million of what we call special rate assets, those assets that qualify for 8%. I won't go through the calculation in detail, but you can see there that in year one, under the current basis, or the old base, or is now the old basis, the benefit is £554,800 of tax saving. Under the new allowances, the benefit is £2,861,400. Now, in actual fact, we've been looking at this quite closely, and my colleague Alistair Wilson's sort of been looking at this very closely. And in actual fact, whether it's a super deduction or whether it's a sensible deduction because of subsequent rates in corporation tax and the impact they have on relief, and whether this just doesn't sort of, in the long term, actually level out the playing field for people, is something that I think is going to be subject to a blog by us shortly. But for now, there is the potential, obviously, to claim significant additional relief, if you incur plant and machinery expenditure in the next couple of years. Next slide, please. So just a point from me then on withholding taxes. So withholding taxes are taxes deducted from payments that you make to overseas companies, overseas bodies, particularly in respect of interest and royalties. Some of you may have attended our Brexit presentations before Christmas, when we said to companies, just be careful about interest and royalty payments, in particular that you're making overseas or that you'll receive from overseas, because when Brexit happened, the UK basically fell out of the EU directives, and we no longer have the benefit of the interest and royalties directive. Now, the Interest and Royalties Directive is actually embedded into UK law. So for an ongoing basis for a number of months, it is still possible to pay interest and royalties to a EU affiliate and not have to deduct withholding tax, which is what the Interest and Royalties Directive is about. But that is being withdrawn from the 1st of June 2021. It's being taken out of legislation. And so from that date, interest and royalties paid to overseas affiliates won't benefit, and withholding tax will be deducted from will need to be deducted from those payments. What's also been included in the budget is what's called anti-forestalling wills, or notice of anti-forestalling wills. So if you had a lot of interest and royalties to pay and you were going to pay those, say, in August, then if you tried to accelerate those payments forward, and the reason that you were trying to do that was you were trying to get in before the withholding tax had to be deducted, then basically Hmrc can set aside what you've done. Our recommendation to people is review the status of interest and royalty payments to EU affiliates for those of you who are part of groups with EU affiliates. Because the situation has been changing, it is changing, and you may need to think about, first of all, what discussions you need to have with overseas affiliates about whether they can recover the withholding tax, and also whether structural changes aren't needed in respect of funding and intellectual property because of the changes in withholding tax. So there may be a bit of work to do there going forward. And I know certainly a number of groups have already been looking at that position, and I'd recommend everyone who is potentially in that position should do that. Next slide, please. So buried in the budget papers, but something sort of us tax specialists always go to, is what Hmrc is doing around avoidance, evasion and non-compliance. So this is around action to close the tax gap, where this is the tax that the tax laws should enable us to collect, but they don't because of avoidance, evasion and non-compliance. The government is publishing a response and looking to increase the level of sanction against promoters of tax avoidance schemes, and also change the nature of penalties and follower notices to target those companies who've been involved in what Hmrc would consider unacceptable tax avoidance schemes. One really interesting point, and it's perhaps something people don't appreciate, is Hmrc's information gathering powers are now extremely wide. They can look at a lot of information in respect of bank accounts, in respect of money held offshore. And they're looking now to consult further with overseas tax jurisdictions on accessing data on platforms based outside the UK. So, and they would look to do that from the 1st of January 2023. So effectively, it becomes very difficult to sort of hide things away because Hmrc have access rights internationally, and they're looking to increase those access rights to information held internationally. One other interesting point is they're going to make the holding of electronic sales suppression software, and this is software that actually suppresses what sales you record if you're trading on eBay or something like that, and making an offence to actually hold that software. So businesses who may consider that type of software are actually forced then to disclose the full amount of their turnover. And the government is consulting further on OECD. That's the doing arm of the G20 around taxation. They're consulting more in respect of offshore evasion and looking again at information exchanges that way. So tax authorities around the world working together to combat tax evasion. Okay, dokes. And I think that that's everything I need to say. So I'm pleased to hand over to Claire Williams to talk about employment taxes. Over to you, Claire.
Good morning, everybody. I lead the employment taxes team at MHA Tait Walker, and I'm just going to run you through a whistle-stop tour of the changes that were announced yesterday and other changes that are coming up very soon. We can move on to the next slide, please, Sam. The first thing that I want to touch on is the furlough scheme. Obviously, Andrew mentioned at the start of this webinar that furlough wasn't even a word that was used in this country this time last year. We've had a lot to learn over the last year and it's kept us very busy, that's for sure. We have been advised yesterday that the furlough scheme and the CGRS claiming scheme will be extended to the 30th of September 2021. Which means that for hours that are not worked, whether that's an employee who is fully furloughed or flexibly furloughed, that employee will continue to receive 80% of their wage throughout the period to 30th of September 2021. That will be subject to a £2,500 cap per month. However, the government did announce that similar to last summer actually, employers will also be required to contribute towards this wage from this summer. So in July, employers will be required to contribute 10% and the government will pay 70% up to a cap of £2,187.50. And then in August and September, the employer will be required to pay 20% with the government funding the other 60% up to £1,875 cap. So that's something, it's great news. It's helping to support employment, which is one of the main concerns that this pandemic has brought for the economy. A couple of things to be aware of is you need to check your look back period if you have employees that are variably paid from this month. Previously, you looked back to the 12 months before, so we would have looked back to March 2020. However, at that point, a lot of employees were already starting to be furloughed, so the wages would already have been affected by the furlough pay and the 80% requirement. So actually from this month, where you've got variable paid employees, you look back to March 2019 as your comparison. Where employees are added to a payroll and included within an RTI submission by the 2nd of March 2021, these employees that have been employed since October can be furloughed from the 1st of May 2021, so they can be included within the last 5 months of the scheme. We move on to the next slide, please, Sam. Off payroll working, this wasn't strictly announced in the budget yesterday. In all honesty, I've taken the slide that we presented at last year's seminar and updated the date from 2020 to 2021. But this just shows how long this has been on the cards. These rules were deferred last year, but they are expected to come in this year. We're not expecting any further deferrals. Basically, these rules are to tax individuals that are working in a way that an employee would work, in the same way as an employee would be taxed, where those individuals are providing their services through some kind of intermediary. I'm not going to go into any detail of the rules at this point in time. We have done a recent webinar, which you're always welcome to get a recording of, and we will be doing a follow-up webinar on this on the 15th of March to touch on payroll implications. But basically, the point I want to get across today is if you're not a small company or group in accordance with the Companies Act rules and you're engaging labour indirectly, you need to check your responsibilities before the 6th of April and take action to ensure that you're not exposed to tax or other issues under this scheme. We can move on. On this next slide, I've just set out who should be considering the rules. So I'll start from the bottom and work up, actually, just to mix it up a little bit. But if you're an end user who's based in the private sector, who is not classed as small per the Companies Act or part of a group which isn't classed as small, and you're using indirect labour, you must check out your responsibilities. You have a requirement for assessing the workers that you're using and for issuing something called a status determination statement. There's also a requirement to pass that along any labour supply chain, so that the fee payer, which will be the entity that's responsible for paying the workers intermediary, they know whether they need to withhold PAYE tax and national insurance and pay this across to Hmrc. And then obviously, if you're a worker providing services via an intermediary, this may impact on you. It's likely to result in more tax and national insurance, and it will have a timing impact on you, as rather than paying via self-assessment, you'll be paying kind of on a regular basis as your invoices are settled. And if we can move on to the next slide. Yesterday it was announced that the government are looking at enterprise management incentive schemes. For those of you that are not familiar with enterprise management incentive schemes, or EMI, this is a really tax efficient share scheme that's available to SMEs in respect of employees that are working for them, to allow those employees to obtain a share in the business in future. Part of the rules require that an employee satisfies the working time requirement and makes a declaration to that effect, which states that they work at least 25 hours per week, or 75%, of their committed working time for that employer. Obviously, with the COVID pandemic, a lot of employees will have been furloughed or may have formally reduced their working hours temporarily outside of furlough. Basically, the government have announced that they are introducing an exception to allow these employees to continue to apply for the be eligible for the EMI scheme. Importantly, this relaxation applies to existing EMI schemes, and it will also apply to new EMI scheme participants. So if you're in the process of putting an EMI scheme in place, it's worth considering that if somebody currently doesn't meet that requirement, but it's likely that they will in future once the COVID issues are over, then you would be able to include those individuals within the EMI scheme. The government also announced that they're opening a consultation on whether the EMI scheme should be expanded, and if so, how that should be expanded. Currently, it only applies to SMEs, and once your business is above a certain size, you cannot grant new options to employees within the business. So if you've got a high growth business, it could potentially act as a little bit of a barrier for recruiting and retaining the best talent if you don't introduce those people into the EMI scheme right from the start when the business is small. And they're also examining whether other companies that don't currently qualify for EMI could have access to it in future. So if this is something that you've looked at before and found you don't qualify, or if it's something where you have a strong opinion, we would recommend that you make a representation as part of that consultation. And obviously, if you would like any assistance from us, feel free to get in touch. We can move on to the next slide. I'm just going to touch very, very briefly on company cars. There wasn't much of a change announced yesterday, other than the government are continuing to support their green agenda by allowing low emission vehicles to have low tax charges, and by increasing tax charges on less efficient vehicles. The other thing that I wanted to pull out from this slide, you'll see that the company car fuel benefit multiplier and the flat rate van benefit fuel charge has again gone up. It's only by a small amount. But one thing that I think I say every single year is if you're providing any employees with fuel for private mileage, it's a very expensive business, and we would recommend that you review any fuel policies that you've got in place. Can move on. Other changes that have come through recently, obviously the government announced, I think a couple of years ago now, that by 2024 they would like everybody who's a worker aged 21 and over to receive a national living wage of £10.50 per hour. So the rates going up on 1st of April are a step towards this. You'll see that the main rate's going up from £8.72 to £8.91. And importantly, that has been extended to include 23 and 24-year-olds. Previously, that was only for employees aged 25 and above. And the other rates have also gone up to make inroads towards this £10.50 per hour. An announcement was also confirmed yesterday in respect of an easement for cycle to work schemes. Currently, to receive the tax benefits under a cycle to work scheme, there's a condition that any employer provided cycles must be used mainly for journeys to, from or during work. That requirement has been disapplied because obviously a lot of people are not travelling to work, but it's only been disapplied until the 5th of April 2022. And only in circumstances where the cycle or cycle equipment was already provided by the 20th of December 2020. So this will not apply for new cycle to work scheme investments that are made from now. You had to have had them by December. They also announced an exemption for employer reimbursement of coronavirus antigen tests and also employer reimbursement of expenses covering the costs of employees' home offices during 2020-21 and 2021-22. The coronavirus SSP rebate scheme is going to continue for now in respect of small and medium-sized employers across the UK who can reclaim 2 weeks of eligible SSP and from day one where employees are affected by coronavirus. We can move on to the next slide. The final slide is just really to tie back to Andrew Murby's comments near the start, where we said we would like to see investment in the young workers that are coming through and basically the future of the country. The government currently provide funding for trainees of £1,000 per trainee, where they're 16 to 18-year-old apprentices and those that are under 25 with an education, health and care plan. Going forward, they're going to also fund another £3,000 per new hire between 1st of April this year and 30th of September this year for new apprentices as well. That's on top of the £1,000 per trainee. So you could have, up to £4,000 there for some hires. And the government also introduced a £7 million fund from July this year to help employers set up and expand portable apprenticeships. So this enables people to work across multiple projects with different employers while still benefiting from the high quality training that apprenticeship provides. It also allows employers to benefit from a more diverse pipeline of apprentices. So it really is a good investment in the future of the country. And on that note, I shall pass over to Louise.
Thank you, Claire, and good morning, everybody. I'm going to take you through the VAT changes that were announced in yesterday's budget. Could have the next slide, please, Sam. So the VAT registration threshold will remain at £85,000 for a further 2 years from the 1st of April 2022. Similarly, there'll be no change to the VAT deregistration threshold. Back in the summer of 2020, the government announced a temporary reduction, a temporary reduced rate of 5% to certain supplies of hospitality, holiday accommodation and entrance to certain attractions. That temporary reduced rate was initially only going to apply to qualifying supplies made between the 15th of July 2020 and the 12th of January this year. That was extended to the 31st of March this year, and it was really introduced as an urgent response to the COVID-19 pandemic to try to support those businesses that were going to be most significantly affected by it and the social distancing measures that were introduced. Now, the good news yesterday was that the government have announced a further extension to the reduced rate of VAT for those supplies. So the current 5% reduced rate will continue to apply until the end of September 2021. For supplies made after that date, up until the 31st of March 2020, a new reduced rate of VAT of 12.5% will apply. For supplies made after the 31st of March 2022, supplies of hospitality, holiday accommodation, etc., will then revert back to the standard rate. And again, this is a measure that the government have introduced to try to provide continued support to those businesses who've been impacted by the pandemic. It's important that businesses who are impacted by this rate change understand what it means for them, that they apply it to qualifying supplies only, that their till systems and accounting systems are able to deal with the VAT rate change and any supplies that span the rate change. Many systems will already be set up to deal with a VAT rate of 5% and 20%, but it may take a bit of work to get a 12.5% VAT rate set up in the system. But please do reach out to us if you need any help to determine which supplies fall within the reduced rate and also how to deal with the changes in the VAT rate. Could I have the next slide, please, Sam? So there were also a few administrative points of note that were in the budget yesterday. At the end of last year, the government announced a new payments scheme for taxpayers who had deferred their VAT payments that were due between the 20th of March and the 30th of June last year, who still have outstanding amounts due to Hmrc. Those businesses can now pay the deferred VAT in full on or before the 31st of March this year, or they can opt into the new VAT deferral payment scheme. That's available to be opted into between the 23rd of February and the 21st of March 2021, and you do that via Hmrc's Government Gateway portal online. Under that scheme, taxpayers can make up to 11 equal monthly payments, interest-free towards the outstanding amounts. Obviously, the later in time that you apply to join, the less number of monthly instalment payments that you can be made. All instalments must, however, be paid by the end of March 2022. And I think it's important just to note here that where businesses have any voluntary disclosures or error corrections to submit relating to that period, extra care should be taken with regards to signing up to making the payments. And again, we can assist you with that as needs be. So as you'll all be aware, making tax digital for VAT became mandatory for all VAT registered businesses who are making taxable supplies above the VAT registration threshold, with effect from the 1st of April 2019. With effect from the 1st of April 2020, all VAT registered businesses will be brought into the MTD requirements. So please look out for that if you're not already caught by the rules. As Chris mentioned in his section, there's going to be a new penalty regime for VAT and income tax self-assessment. This is as a result of the MTD requirements for both taxes. For VAT, it will come in for VAT return periods starting on or after the 1st of April 2022, and it will replace the current default surcharge regime. So going forwards after the 1st of April 2022, the late payment regime will be a points-based system, and a financial penalty of £200 will be issued for every missed submission on or after that relevant points threshold having been exceeded. The new late payment regime will introduce penalties which are proportionate to the amount of tax that's owed and how late the payment is. So if your payment's up to 15 days late, there will be no penalty. If the payment is between 16 to 30 days late, a penalty will be introduced of 2% of the tax unpaid. That will then increase to 4% of the tax unpaid, where the amount unpaid remains unpaid for 30 days or more. There then will be a further 4% annualised penalty which will apply to outstanding tax that's due after 30 days. Interest charges and repayment interest on VAT will also be aligned with other tax regimes. Could I have the next slide, please, Sam? So 2021 appears to be the year for changes and in VAT and the introduction of a number of new rules, and therefore just want to take this opportunity to run through a few key reminders for you. So the construction industry domestic reverse charge was introduced with effect from the beginning of this month. This has been introduced in response to organised criminal attacks and involving mis and trader fraud in the VAT system in the construction sector. That currently costs Hmrc in excess of £100 million of VAT be going lost each year. The construction industry domestic reverse charge will impact on supplies of construction services made between VAT registered and CIS registered businesses where those services are subject to a positive rate of VAT, so be that at the 20% standard rate or the 5% reduced rate. It's important that if you're a business either supplying or receiving construction services that you are aware of these new rules and you're aware of your respective obligations under those rules. So if you do need any help, please do reach out to us. Making tax digital again. The second phase of this is being introduced and will apply to VAT returns starting on or after the 1st of April 2021. What that means is that with effect from that date, Hmrc require businesses to have in place digital links between all parts of their functional compatible software that's used for preparing the VAT return. So that goes right back to the systems that you use for recording and preserving your digital records, for providing information to Hmrc and submission of the VAT returns via the API platform. We recently held a webinar on the digital links requirements, so if you're interested, we can send you a link to that and have a chat with you with regards to how digital links may impact on your business. Brexit has been keeping our team extremely busy since the turning of the year. There are a couple of important reminders in relation to Brexit. So postponed import VAT accounting was introduced with effect from the 1st of January 2021. This is applicable for all imports into the UK with effect from that date, be that an import from the EU or an import from the rest of the world. It provides a cash flow advantage in comparison to the payment of VAT, import VAT at the port and then later recovery using the C79 certificate, as instead any import VAT payable is declared and reclaimed on the VAT return. You do not have to apply for this to take advantage of postponed VAT accounting. All you need to do is make sure that your customs agent is aware that you want to take advantage of it so that the C88 form is correctly completed at import. Similarly, where businesses have taken advantage of the deferral to make full import declarations for non-controlled goods that have arrived into Great Britain from Europe between the 1st of January 2021 and the 1st of July 2021, there will be a requirement to make sure that those full import declarations are submitted by the required due date and that those businesses have procedures and controls in place to make sure that full import declarations are done with effect from the 1st of July 2021. There are some new EU VAT rules being introduced with effect from the 1st of July. These primarily affect those businesses who are involved in business to consumer transactions and where they supply services, goods, where you've got supplies involving marketplaces and postal couriers. There are fundamental changes to the rules, and therefore if you do have a business that operates in this sector, I do recommend that you reach out to us and we can take you through how those rules will impact on your business specific circumstances. So that, like I said, there are quite a lot of changes happening currently with regards to VAT outside of the budget announcements, and if you do need any assistance, please do feel free to reach out to the team. With that, I'm going to hand over to Alistair.
Thanks, Louise, and this is now the home straight in terms of our presentation, so I'm just going to run through quickly some of the other points that were of note in terms of what was discussed, and then our view overall. So the first point that came out was obviously, I suppose, an extension in terms of the reliefs for business rates. Now, for non-domestic rates, relief in terms of retail, hospitality and leisure properties, this has obviously been something that's been very beneficial over the last 12 months, albeit necessary because a lot of those premises have been closed for large parts of the last 12 months. The government are extending the relief at 100% up to the end of June. They're then going to extend the relief at a further 66% for 9 months for eligible properties. Over the year as a whole, so through to March 2022, this will equate to 75% business rates relief for many businesses. Whether or not you qualify, you're likely to know from what's happened in the last 12 months I guess the key point with business rates is to bear in mind that come July onwards, there are going to be business rates to pay, even though it may be at a much lower level. We move on to the next slide, Sam. The next area where there was movement in terms of from the Chancellor was the continuation in terms of the exemption on the relief from stamp duty land tax. Now, we've caveated that this is England and Northern Ireland. Wales and Scotland have got their own regimes. Scotland's exemption or reduced rate of what is land and building transaction tax comes to an end at the end of March. Wales's comes to an end at the end of June. So what's happening in terms of England and Northern Ireland is actually more generous than either of those two devolved assemblies. The exemption on the first £500,000 is extended to the end of June. It then phases down to the first £250,000 to the end of September. And then after the end of September, you're back to the normal rules. So for those of you who want to move house, you may want to make sure that you have that in progress as quickly as possible. We can move on to the next slide, Sam. Just very quickly on this, and I've spotted a typo in the first column. The fourth line down should say 8%. That's my bad addition. These, in terms of people buying second properties, so holiday homes, there will be I suppose, a number of people who are looking at staycationing and may well be wanting to see this as an opportunity to buy a second property and to pay reduced stamp duty as a result. Again, the same message applies. You may want to, I suppose, move quickly on that if you want to benefit from reduced rates of stamp duty. So either 30th of June or 30th of September may well be your deadline. And if we can move on to the next slide. In terms of other positives that came out of the announcement yesterday, so these are some of the more general matters, so not tax specific. There is a new initiative being announced called Help to Grow that we see as being a very good idea for SMEs. It has got two different aspects. There is Help to Grow Management and Help to Grow Digital. In both cases, they are intended to try and encourage SMEs to look at what may be some commercial weaknesses that they have and to use financial support and support from, I suppose, local universities or local advisors to try and either adopt better leadership and management training or to adopt things like software which helps to build customer relationship and sales, online selling, or what might be digital, I suppose, digitally enhancing your finances. Probably one of the key things for SMEs in terms of the digital aspect would be looking at things like what might be Microsoft Dynamics or Salesforce, looking at things that can help businesses to compete, as nowadays, as we've all learned, if you're working remotely, there are businesses who are very fast adopters of digital technology and there are others who are slower. So this is to try and encourage a acceleration in terms of update in terms of digital technology. We can move on to the next slide. And then just in terms of the management aspect of Help to Grow, again, we see this as a good thing for the region. This is a series of 12-week courses that are going to be run in conjunction with university business schools. Those courses will provide mentoring, peer networking, an alumni network. They will be funded 90% per applicant by the government. So employers who will be SMEs, they will have to pay £750 a head, but you can work out what the overall cost of delivering those courses is. The applicants must be decision maker levels, so they're likely to be board level people. And we've included a snapshot there of the different things that will be included in the courses. The website that the government have set up is live. You are able to register your business to participate, or at least to express interest in this. And we would say if you're an SME in the region, this is a good thing to consider because it is likely to help you to accelerate the growth of your business. Move on to the next slide. One thing which was announced yesterday, which again we see as being potentially very helpful to the region and potentially places like the more rural parts of the region or smaller urban areas. The government are setting up what's known as a community ownership fund. That's going to be £150 million worth of funding that can provide match funding, typically up to 250,000, but up to £1 million for community groups to buy or take over community assets. And what they're thinking is local pubs, local sports clubs, theatres, other venues which are local or important to the local community, and to stop them falling into disuse. That's what the government are intending here. They have also extended what is known as the social investment tax relief. And the social investment tax relief, it is a way of providing quite a high level of income tax relief to people who would provide funding for this type of project. If you've got individuals who want to back a type of project that the Community Ownership Fund was able to fund, then those individuals may well be able to get income tax on providing the funding that the government don't provide. So all of that is intended to help local communities keep assets, keep properties, keep local facilities up and running. So that's a good thing. Move on to the next slide. Just as one corporate finance related matter, the Recovery Loan Fund, which the government announced yesterday, it's like a slightly different version of the CBILS schemes. That's going to run from the 6th of April through to the 31st of December. It can be used to facilitate up to £10 million worth of debt finance. The government will guarantee up to 80% of the finance. There aren't supposed to be personal guarantees taken on finance up to £250,000, and the main residence of the person who is asking for the finance shouldn't be taken as security. And so this is a variant of the CBILS scheme that has been in place already. So again, will hopefully help businesses to grow, or at least to have the finance in place to enable them to recover from the pandemic. Okay, and then finally on to my last section, Sam. What's coming next? So this is a bit of a roundup, just in terms of how we view all of this. So for everything that was announced yesterday, there were lots of positives. There were lots of very good measures for our region, lots of very good measures for businesses. But did the Chancellor just put off some of the harder tasks? Was yesterday a populist event which gave us lots of positives, but might in fact have just kicked some of the harder tasks down the road? There is a requirement to balance growth with raising tax, and the Chancellor yesterday appeared to be trying to do that, and we'll demonstrate why that's the case. There is a structural tax imbalance between employees, the self-employed, and people who are working as consultants for businesses, and there is definitely a momentum shift to try and tackle that. Capital gains tax, well, that's something that has been consulted upon, and may we see that coming out on the 23rd of March as a consultation, as a negative that the Chancellor didn't want to talk about yesterday. That could still be the case. Corporate tax, well, we may well still have a low tax rate in comparison to the G7, but our next door neighbour, the Republic of Ireland, has a corporation tax rate of 12.5%, and they're a member of the EU. And so some of the issues that businesses have been experiencing trading with Europe, it may well now be the time to really consider whether a subsidiary somewhere like the Republic of Ireland makes a lot of sense. We have the leeway to change our VAT now that we're outside the EU. Will the Chancellor start to make some changes now that help to benefit us? And has he fixed the imbalance between online retail and high street retail? Well, business rates, as they come back into charge, we will start to see again the same issues rearing their head that we had previously. Can we move on to the next slide? Thanks. So, if we're not going to make the changes now, then when? So how will the Chancellor raise taxes in the future? Was this good news with bad news to follow? Is it really tackling some of the issues that were expected? There is a reasonable chance that we could have an October 2021 budget. As we get to the autumn, if the pandemic really is behind us, that might be a time whenever further bad news might be appropriate. There is a tax consultation day already announced for the 23rd of March, where some of the issues that have been raised may well actually start to be tackled by the Chancellor. So there is a question, is this a populist government who are ducking the hard choices, or will some of the bad news just come later in the year? We can move on to the next slide. And just something for people to be aware of, there is an ongoing investment in Hmrc. In terms of their IT technology, they are very significant recruiters of IT specialists nowadays. Their IT systems do enable them to understand what is going on with taxpayers a lot better than they used to. They are moving as much as possible to requiring taxpayers to adopt digital means of communication, and that will enable Hmrc to target and collect taxes by much more rapidly targeting non-compliance or identifying people who aren't doing things simply due to their computer systems, identifying people who aren't being compliant in the way that Hmrc would want. So that is going to be something that will raise revenues for Hmrc. And so then to the final slide. So overall, what was the outcome in terms of this budget? Well, businesses and their owners should read the small print. What was announced yesterday in terms of the short term, it feels very positive because the government were giving away a significant amount over the remainder of this tax year and into next tax year in terms of support. It's definitely something that feels good at the moment in terms of helping to support business. But are we going to pay for it? Yes, we most definitely are. Using the Chancellor's own figures, by the end of this Parliament, he's collecting £29 billion a year in extra taxes compared to where we are today. Now, one of the important things with that is that increased tax take, as you'll have seen from the press, that is now the highest in approximately 50 years. And it's going to be something that could go on for quite some time. Now, whilst the Chancellor may take the opportunity to ease some of that immediately before the next election as a vote-winning exercise, businesses should be prepared now that the tax take, the tax cost of being in business probably is going to be significantly higher for some period of time than where it is today. And with that, we will bring our presentation to a conclusion as we move on to any questions. Now, we have been answering questions as we've been going along. There was one that I just wanted to highlight that came from, just go back, it came from Dave Thomas at NEL Fund Managers, and I actually quite liked it as a question, so I just wanted to highlight it to the participants, which is, do you see an overall positive or negative for SMEs from the changes in corporation tax announced? That's one where certainly on our side, we would see this as being, I suppose, kind of timing, in that it's something which there is a positive now, and there are things that businesses can do now to optimize their cash flow by taking advantage of the short-term measures that were announced. But in the long term, there definitely is going to be a cost to all of this, and the increased corporation tax rates, that is going to be quite a significant step up. In practice, you're looking at somewhere between 25% and 33% in terms of the increase and what that means in real terms for corporation tax purposes. So it is definitely something that we would see as good news today, but potentially painful in the long term. I have seen a question from Tony Douglas as well in terms of help to grow. Would a decision maker include a finance manager in an SME? What we can do, and I think one of my colleagues is trying to see if they can find it. What we can do is we can share the link to the website that the government have set up. What you're able to do at the moment is register the interest for your business. We'll circulate the link for Help to Grow so that everybody knows where it is, and you can register interest for your business. Ultimately, because it's a government-run scheme and it was announced yesterday, I suppose the detail of exactly who and what decision maker means in this context is probably fairly fresh. So we'll help you try and see where you can go to answer that question.
Just to add to that, I have just put the link into the Q&A function, but we can obviously send that out as well.
Thank you, Claire. Perfect. And with that, if that answers all of the questions that people had today, hopefully that was a good, I suppose, summary of the key things that we saw came out yesterday. We've posted on screen the contact details for everybody who spoke today. As one final point, I think, Sam, do you have the details just of the next couple of events we've got coming up? We have got a couple of upcoming MHA Tait Walker webinars. One of those, which is about how businesses can go about dealing with IR35. That is a really critical thing for businesses to make sure that they are on top of, because it goes live from the end of this month. And in terms of the detail on corporation tax and how to optimize the benefit of the new changes that were announced yesterday, we're going to do a follow-on event on the 24th of March. So hopefully you're able to join us for those. But in the meantime, if we've answered all of the questions from everybody today, I would say thank you very much for joining us. We hope you find this was a useful event, and thank you very much to everybody who presented today.